Hi there, welcome to Know Your Options. Every second Wednesday, we dive into the world of options trading. We touch on the fundamentals of puts and calls and how you can effectively incorporate options as an investing tool to maximize returns and also manage risk. Now, we want to get your questions. Please call us toll-free, 1-855-326-6266, or email us at knowyouroptions@bnnbloomberg.ca. We'll answer your questions, or rather, our options specialist will. Chris Tom, CEO, Portfolio Manager at Moat Financial, joining us there from scenic Vancouver. What's the temperature roughly, Chris, would you say, in that part of the world?
I think it's around 7, maybe 8 degrees here.
Okay. All right. We'll sit here.
Not the same as Toronto, I think.
No, we'll sit here and freeze. Chris, thank you very much indeed for joining us as ever. You touched on this previously, but we're going to drill into it a bit more. Leaps, what are they? How do they fit into the world of options?
So leaps are, effectively they are any option that is longer than a year. So they actually stand for long-term equity anticipation securities. Mm-hmm. So full disclosure, I actually had to look that up to confirm what that was. It's been quite some time since I did my options licensing test. And I don't know, if you look at that acronym, I don't know how it came to be. It doesn't really add up. But effectively, any option that's longer than a year is considered to be a leap.
And tell us how they work then.
So, the fundamentals of how they work is the same as any other option. So the exchange will list them, and then the market will set the price of what those options are. So one of the big differences between a leap and a shorter dated option is really just the rate of decay, which we'll touch on that in a little bit.
Okay.
Options, as we know, we always talk about the fact that they're a wasting asset. So oftentimes when we are doing trades on here, we're recommending selling cash covered puts or selling covered calls, and the profit comes from the decay that happens in those options as we get closer to expiry. The difference with leaps is that decay is happening at a slower rate. Okay, so I can see there's the chart there. So you can see that the price of an option, if it was starting at $10 over the course of 3 years, that's just going to gradually decline over the, say the first half of the life of that option. And as we get closer and closer, that option's value will really decay at a much more rapid pace.
I'm guessing that, say I'm buying a call that goes out more than a year, I'm going to be paying a fat premium because that's a pretty valuable thing to have.
Yeah, when we look at buying options, again, we're on here always talking about selling options, but if you're buying options, the challenge is always that you need to get the direction right, the timing right, and the amplitude right. So those are 3 things that are difficult on their own, and to do all 3 at once is even more difficult. So the nice thing with leaps, if you are trying to make a directional investment, so say you are buying calls as you stated, and you're wanting something to go higher, you can make that directional bet, and so you need it to go up, and you need it to go up by a certain amount. But your timing has a lot more flexibility because the clock isn't necessarily running as hot when you put that on. And when we were looking at that chart there, if you bought something that's say 2 months out, and it was a certain amount out of the money, and you paid $1, well, that thing's going to go to 0 in 2 months. That thing's going to decay from $1 all the way to 0 if it doesn't do what you want with the underlying stock. Whereas if you buy that leap, say you had to pay $10, so you're outlaying 10 times as much, over that 2 months, it might only drop by 40 cents or 50 cents. So the amount that it's decaying on you, or the percentage of your outlay, is much smaller. So you really get time on your side if you're making a directional bet, as you stated there.
And so who would buy a call with a term to expiry, a leap of more than a year? Who would do that?
So on the call side, it's someone who thinks, hey, this business is going to grow, or there's going to be some innovation, or there's going to be a new discovery, or there's going to be something big that's happening with this equity. I just don't know when. And if you're doing it in a way to try to capture some leverage, then you're doing it so that, look, I'm certain that this is going to go in the direction that I want, but I'm not sure of the timing of it, so I'll buy something further out. On the put side, oftentimes that's an insurance play. So you've got an equity and you're wanting to protect it, not just for a few weeks or a few months. You want to go out over the longer term to protect the downside on that. And you want to pay less per month because, the option decay is not quite as fast. The other one is, if you really think a stock is going to implode, or, what's happening in a lot of these AI-related names, we'll use Michael Burry as the example, where he made some pretty big bets against NVIDIA and Palantir. He did those with options that were about 18 months or 2 years out. So he's expecting those stocks to drop and drop in a big way. He just doesn't know when the catalyst will come, so you buy those leaps, and even if it doesn't get all the way down to where you have set those strikes, if the stock drops in the near term, you will start to participate in gains. So it's really just making a longer term, extending your timeline for what you think will happen to happen.
And so let's say I buy a tech stock and it does drop, and it drops, say, 30% below the strike price. Sorry, I bought a put. Let's just say, I meant to say I bought a put and the stock drops 30% below the strike price. I guess one of my options is to exercise my put and put a 30% profit in my jeans.
For sure. I mean, if you were to buy a long-dated put and it were to drop, and it was out of the money, and it were to drop 30% below what that strike was, you're going to make a lot more than 30%. You've got a big leveraged play on this.
Yes,
you're probably making multiples of your money. So, the first thing you do is decide, hey, do I want to sell this stock? Do I want to just close out this put position and make this return? The key thing here is to just not brag to your friends too much that you've made such an excellent trade. But yeah, if you're doing that and you're setting this long term, you don't have to exercise that in order to fulfill the full value of that trade. You can just sell that option to the market and drive on to the next trade.
Yeah, I didn't put that very well. Of course, your leverage is much bigger, because you've only put the premium in there. So you've two options. You can exercise, or you've two choices. Let's say you can actually exercise and buy, and you're buying the stock at 30% below what the price that you're allowed to sell it. I'm sorry, I'm getting a bit tangled up there.
Yeah.
Or you can simply sell on the
option. A lot of times what you'll see.
Yep.
Sorry, well, a lot of times what you'll see is someone says, okay, I own this stock, I want to insure it. Okay, stock's at $100, they buy an $80 put. Stock gets clobbered, goes to $50. So now they are able to sell it to whoever they bought that option from for $80. And so a lot of times what you'll see is the owner of that option, the person who bought it, the person who made that hedge, they will wait until there's a dividend coming. So once that dividend is going to exceed the amount of time value left in that option, they will, if they own the stock, they collect the dividend, and then at the end of the day, they reach out to the market and say, hey, I'd like to exercise this. Then that stock gets pushed over to the guy who sold them the put, and he gets it the day after the dividend, and you get your money at that $80 strike that you had set for your insurance. So, yeah, you can close these out early, or you can send the stock to the person who sold you the option.
Thank you very much, Chris. We're looking forward to the next segment as well. Chris Thomas taking your calls and emails on options, 1-855-326-6266. Get on the phone now because times are wasting. And as it always is in the world of options, or you can email us, knowyouroptions@bnnbloomberg.ca. We'll be right back. Jason is on the line from Vancouver. Go ahead, Jason, and thanks for calling.
Hi, Chris. Love the show, and congrats on launching your ETF. So I'm wondering, if I sell puts on a U.S. stock, do I have to set aside U.S. cash to be cash covered, or can I keep it in Canadian dollars? And what are you doing in your fund? Thanks. I'll hang up and listen.
Yeah, thanks for that question, Jason. That is a very good question. So I guess the short answer is, if you have the cash, you've got the collateral to sell puts, and you're selling U.S. listed puts, but you've got the Canadian dollar cash, like technically you are covered. For us, we typically will, if we're selling puts on U.S. securities, we want to be cash covered in USD. The reason for that is because a lot of times when you see, so ignore like the recent little bit here where, currency and gold and everything's just kind of going wild. But normally when you see U.S. securities go down, U.S. stocks go down, you see the U.S. dollar go up. So if you keep everything in Canadian dollars, you are going to be forced to buy that stock and buy U.S. dollars at the same time. So it can be a situation where you lose on both sides. So for us, we typically are just trying to be currency agnostic. I mean, over the course of time, there's going to be periods where, being long U.S. dollar versus the Canadian dollar helps you, and other times when it hurts you. So to be truly fully cash covered, I would say, just go with the currency of the security that you're going to buy, but don't necessarily do it because you're making a bet on one currency versus the other. And then that way you'll be fully cash covered. But if you really think, hey, you know what, we're in a period where the US dollar is going to decline as well as these stocks are going to do okay, you can keep that money in Canadian dollars, but you just have to be fully cognizant of what you're setting yourself up for.
Okay. We have Patricia calling from Toronto. Oh, I'm looking forward to hearing what you have to say about this stock, Chris. Patricia, go ahead, please.
Okay, thank you so much. Jason, correct? Sorry.
Oh, Chris.
Chris, sorry. You did have a recommendation on selling puts on NextGen on previous shows, and I wish I had gone ahead and done that because I feel I've missed it. Could you please provide an update on your recommendation on NextGen?
Thanks.
Thank you.
That's a red-hot uranium stock, of course. Go ahead, Chris.
Yeah, for sure. So, we sold puts on this on the December 31st show for January, and then we sold puts on the last show for February or March. I can't remember. The stock, as you said, has just been on fire. So this is one where we are going to make money. If a person did those trades, then I think you'll be making something in the neighborhood of 8 or 9% over the course of a couple of months, which by most measures is a good return. This is definitely one that we'll look at this point and say, hey, I wish I had just bought the stock because it went from $13 to where is it now, almost $19. So we were taking a lower risk avenue to get exposure to this, and we're getting a lower return, which that tends to line up. So for now, if I just take a look at my screen right now, we had been selling the $12 put, and those are a little bit far out of the money. So I'd say that ship may have sailed. But you can look out to March and sell the $15 put. So we're still $3.73 out of the money before we get to that strike, and you can collect about 43 cents. So 43 cents on $15 is just about 3%. You've got about a month and a half. This is a meaningful period of time for them. In February, they've got their earnings, as well as they have their final hearing for whether or not their Rook project will be going through. So you can expect some volatility up or down on this name. And so on this one, I wish that all we did was buy the stock, but we're still going to make some money. And if you still think that $15 is a decent entry point, then you can look at selling those puts and still keep it relatively tight here.
Thanks for the question, Patricia. We've got Fred in Nanaimo, BC. Go ahead, Fred, please.
Hello. Thanks for taking my call.
Pleasure.
I recently sold a put option. Now, when it came close to the strike price, or to the strike price as well as the expiration date, I was thinking about actually purchasing that option back. So I would essentially be buying the stock. How would I go about doing that before the expiration date? Thank you.
Okay, so if you sell a put, let's just talk about NextGen. Let's just use that example from the last caller. So, today it's $18.75. We sell that March $15 put. We collect 43 cents. As we get closer to expiry, like we talked about, the decay on these options is going to accelerate. So if the stock stays around where it is now, that option is going to get closer to zero. Now, because, if the thing stays over 15, it'll still decay very close to zero as we get closer. So these options, they trade in the market. You can buy them and sell them any day. So if you decide, okay, look, this thing's getting close to expiry and I want to buy it back, you just buy it to close. And then if you decide you want to buy the stock, you just do that in the open market as well. So you do that as two separate transactions. Remember, if you buy a put option, you have the right but not the obligation to sell that stock for a certain price. But if you're the seller of that option, you don't have any rights. You've given those rights up in exchange for money. So there's no transaction you can do that's sort of a one-stop shop to tell the exchange, hey, I actually do want to take delivery of this right now. You don't have that right, but you can always buy the option back to remove your obligation and then just buy the stock in the market, and now you're long.
Right. Okay, so you go in and you buy the option that you sold. You just buy it back.
Yeah, you buy it to close. So you sold the thing for, say, 43 cents, if we're sticking with that example. And then here we are, a couple days before expiry, the stock's above that strike. The most of that time value should decay. So maybe you buy it back for 4 cents and you buy it to close. And now you've sold it for 43. You bought it for 30 or for 4. You made 39 cents and you're free and clear to do what you want with your cash going forward.
Rafi's in Brantford, Ontario. Go ahead, please.
Hello, sir. I'm looking to find out about TDS, and I'm a long-term investor, and I'm hoping...
I've lost you here.
Oh, okay. Rafi's asking about a stock, Telephone and Data Systems, NYSE, TDS. Maybe we can put it up. Chris, is that one that's on your radar? Or we're looking at it now. It's up 23% in the past year, and it's a 43.64 stock. Is that on your radar? Oh, I think, sorry, Chris may have lost us altogether. I'm afraid we're going to have to go to break, but don't go away because we're going to get Chris's top options trading ideas right after this. We're going to get to Chris Tom's top options trading ideas in a moment, but let's just loop back very quickly. We had a caller asking about TDS, a stock that trades in New York. When you look at a stock like that, what is your view? Of course, it's telephone and data systems.
Yeah, so not super familiar with this business, but I can take a look at the options here. My understanding is this caller is a long-term holder of it. This is one where the calls and puts, the liquidity is not great. Okay, so this is one where you're going to want to, if you're looking to sell a call on it, so that's what a long-term holder would do. Here we are, the stock is say 43.50, and you're looking to sell some calls. This trade's actually in $5 increments. Okay, so your choices are going to be to sell the 45 call or to go up to the $50 call. Now, you're going to need to decide what you want to sell these options for. and then put that price in and either get a fill or don't, okay? The spreads are quite wide on this. So this is one where, sometimes we talk about how Canadian options get a bit of a bad name for having bad liquidity. And here we are, a name that just isn't as widely traded. So if you're looking at going out to, say, April and selling the $50 call, I think you could put that in at about $1.25 and maybe work it down to $1.10. And if you get a fill, you get a fill, and you're getting some income to that with quite a bit of upside. But otherwise, it will be a little bit tricky to sell some options.
Right. Let's get on to your ideas. Rogers Communications, you're suggesting selling a put on this stock with an exercise of $48, and it expires in March.
Right. So this is an interesting one. They report tomorrow, so there's a little bit of extra implied volatility in these options. So stock's 49 and change. We're looking to take delivery of this at 48 if it goes down. And for that, we'll collect $1. So just over 2% for about a month and a half of a commitment. And if the stock goes down, we're happy to own it at that level. I mean, our attraction to Rogers really is outside of the telecom space. It's become pretty clear that even though we have sort of three major players in Canada, it is a tricky business over such a big area. But we like the sports franchise, and our hope and goal for them is that eventually they spin that out and have really a monopoly on the majority of the sports in Toronto. And they've got the only baseball team, the only basketball team, and not a lot of scope for competition north of the border. So we like that eventually. And I think, if we take delivery at 48, then that's good value.
We're tight for time. Dell, you're suggesting selling puts on Dell for a price of about $275 US, and the strike is $100.
Right, so Dell's about 117. We're looking out to March again, selling the 100 put for about 275. That's 2.75% of that strike. And we've got quite a bit of downside, about 17% downside protection before we hit that strike. At that level, we're buying shares at the same price they were trading at a couple of years ago. Trading about 15 times earnings. This is an infrastructure play within the AI space and not trading at a crazy valuation. So we're happy to own it if it pushes down to that price.
Right, because you're getting it $100. You're getting it at a slight discount, aren't you? $275 that you got.
Yeah, when the stock was trading at 150 plus, that was an expensive stock. So we're looking at taking delivery well below the 52-week high.
Right. Okay. And then your final idea: sell puts on CP Kansas City. You'll get about $1.75 per option. The strike $95.
Right. So CP is trading around 98. These guys report in about 35 minutes. And if the stock gets below 95 between now and March expiry, we're happy to take delivery for about a 1.8% yield. That's about 2 years worth of dividends. And if you look at a longer term chart on this stock, I mean, we're buying it at the same price it was trading at 5 years ago. And it's pretty difficult for new entrants to come into the railroad space. So we like it.
Thank you very much indeed, Chris. Always great hearing from you. We're out of time on Know Your Options. It'll come back 2 weeks, Wednesday, 3 p.m. Eastern Time. We got the close up next.